Yahoo Finance call of the day has nothing to do with crypto or would-be stock market corrections, but rather space. Deutsche Bank Analyst Edison Yu is out with an initiation on upstart rocket launching company Rocket Lab. The price target of $18 on Rocket Lab calls for about a 17% move higher in the stock. Edison Yu joins us now. Edison, good to see you here on This Morning. So you call Rocket Lab, quote, the highest quality space asset to enter public markets so far. Why is that?
Sure, and thanks for having me on this morning. So there's two main reasons for why we say that. First is Rocket Lab's track record. If you look at all the launches they've done 21 launches to space. They've succeeded 19 times. So it's over a 90% accuracy rate. And it's just very, very uncommon to see that in the industry. If you look back in just the last couple of months, you've seen actually two failures from some of the other upstarts. And it just shows you that getting a rocket into space is extremely difficult. And that heritage of reliability is very difficult to find. So at the rocket launch level, these guys are just extremely high quality, extremely reliable, which is rare. The second reason is the company has gotten an incredible amount of traction, especially recently on the satellite business. And this business is basically, you have a rocket, right? And you have to take something into space. They're getting more value add from the payload that's going into space, which just demonstrates the power they have in terms of customer relations, in terms of backlog, pipeline, into other things just beyond taking stuff to space. So we think because of these two drivers that the company is arguably probably the best space launch asset, even space asset to hit the market over the last year.
Edison, this is Emily. Because this is such a frontier industry with perhaps not a ton of obvious other public companies to use as benchmarks for comparison, what metrics do you think investors should really be focused on here with Rocket Lab to gauge their relative success?
Sure. So we look at, I would say, two things. First is the backlog and pipeline, or in other words, how much traction they're getting with customers. As you very accurately pointed out, right, the revenue is very low right now. This is a very nascent market, but I think everybody would agree, based on a lot of the macro drivers and industry drivers, that this is going to be $100 billion, even $1 trillion industry going forward. So we think Rocket Lab, even if they capture a very small portion of that, it will be an extremely valuable company. And just to give you a demonstration of how much traction they've been getting, if you look at the backlog they've gotten with customers coming out of September, it's about 170 million. And this was only 60 million about a year ago. So that's incredible growth in the backlog in just about a year. If you look at the pipeline, they were only looking at about a $2 billion pipeline early this year. That pipeline has grown to over 4 billion. So you can see that just the amount of traction they're getting with customers is extremely, extremely strong. The second thing we would look at is basically, it's a bit more of a, I would say, qualitative metric, is just basically the amount of success they can get with launches. And they had a little hiccup earlier this year, but then you saw that a couple months later, they launched essentially flawlessly into space. And basically every launch going forward will be scrutinized to a very, very, I would say, high standard because of their incredible flight heritage. So I would say these two things, customer traction and launch success, these are the metrics that we probably want to monitor closely. And we don't want to pay, I don't think people will really care too much about, for example, what was the operating margin in the last quarter. It's just these things that they take scale, they scale up very quickly. And we wouldn't be focused too much on that in the near term.
Edison, you write in great detail about a new rocket for Rocket Lab called the Neutron. What is that? When does it launch, and what does it carry?
Sure. So the way to think about Neutron is, I would say, twofold. To your question directly, it launches in 2024, assuming everything goes on track, which is by no means a slam dunk, given the space industry can be, anything can happen. But it's supposed to occur in 2024, and we have fairly high confidence that it will. And the key to this is that it's going to be able to carry a lot more into space relative to the current product, which is the Electron, and that's a small rocket. So if you think about it in numbers terms, Neutron is going to carry about 8,000 kilograms, and Electron, which is the current rocket, carries about 300. So it opens up a very new opportunity for them to bring a lot more to space per launch. And that's basically the key kind of TAM expander for them on the rocket launch side. The second part, which is a bit more, I would say, difficult to say, is this Neutron rocket will actually be able to carry humans. If you think about the small rocket they're doing right now, that is not designed to carry humans. And once you start carrying humans, that opens up missions to the International Space Station. I mean, we could talk about the moon. It just opens up another set of possibilities that at the moment it may not be very evident. But if you believe that civilization is getting much more interested in space and wants to explore the cosmos more, this is going to be a key part of that.
Deutsche Bank analyst Edison Yu with today's Yahoo Finance call of the day. Really enjoyed this one. Have a great rest of the week. Still having a problem finding a new or used car? You aren't alone, as the semiconductor shortage has caused major manufacturing downtime at the likes of Ford, General Motors, Toyota, and many other automakers. Strong auto demand due to the pandemic hasn't helped the inventory issue either. Let's get a look at the lay of the land in auto retailing with Carvana CEO Ernie Garcia. Ernie, always good to see you. Good morning to you. I was driving this past weekend. We have a row of dealerships by my house, and really there were no cars on the lots. It was striking. I just forgot to take a photo. I was surprised that this continues to go on. Are you still having difficulties getting the inventory you need to really match a consumer that is clearly willing to buy a new or used car right now?
Sure. Well, so I think there's two different interesting issues going on right now. I think what you saw is all about new car manufacturing, and I think that that's really struggling as a result of the global supply chain being heavily impacted by the subsequent waves of COVID, leading to a decrease in new car production. I think what we at Carvana feel, there's all the used cars already out there. They're on the road today driving around, but we've been growing very rapidly. And so as we grow, we do all kinds of different things. We open inspection centers where we put about $1,000 into each car to certify it up to our standards. We ship those cars around to customers. We have a bunch of other operational functions to support customers that go through the whole transaction. So our supply side constraints have been more about scaling the business, not about getting access to physical cars. But on the new car side, certainly that's a problem today.
What are some of the trends that you've seen just in the past month or two as it relates to prices and sales of these used cars? Because one of the things that really stood out to a lot of people in the last Consumer Price Index report that we got out was that the index for used cars and trucks declined 1.5% in August. That's after 5 straight monthly increases. So are you seeing that demand is coming off a little bit on the consumer side?
So I think one relatively simple way to think about it is that I do think that basically new car production leads car prices generally, both new and used. And I think as we see COVID waves, not necessarily just in the US, but globally, the supply chains of all the manufacturers get disrupted. These supply chains are really broad global supply chains with parts coming from all over the world. There's a lot of attention on semiconductors and microchips today, but really there are different parts coming from all over the world. And so as those manufacturers run into trouble with the production of those parts and they can't produce cars, that leads to a dearth of new cars. And then when there's not enough new cars, that leads to price increases across the board in used cars as well. So what we've actually seen over the last month is we saw used car prices start to rise again. They had dropped for about a month and a half, and they just started to rise again, especially in the wholesale markets and just more recently to a lesser degree in the retail markets.
Those supply chain challenges you mentioned, Ernie, where are they most acute? Is it finding people to work to help recondition the cars you do ingest? Is it building materials to help build those really big vending machines? Where are you seeing this?
So for us, it's the entire operational chain. So, we just came out of Q2 was the last quarter we reported. It was an incredible quarter for us. It was our first quarter we sold over 100,000 units. We grew at 96% year over year. It was our first quarter of $5,000 GPU. It was our first profitable quarter. So it was an incredible quarter. in order to power that kind of growth, we're growing the entire apparatus of our business. So whether it's purchasing cars directly from customers, purchasing from other sources, certifying those cars to get them up to our standards, shipping those cars around the country, answering customer questions as they have questions about the car, our process, last mile delivery to the customer. There's so many parts of our business that we're scaling up, and we're 100,000 sales for the first time in a quarter in Q2, but we're still just 1% of the market. So the opportunity in front of us is still very much like a startup opportunity. So we're just working really hard across the board to scale that whole apparatus up. And I think that to some degree that's actually independent of the pandemic. That's more just a function of the growth that we're experiencing as a result of our new offering and the great experiences we give to customers.
And Ernie, we've followed your business for quite some time, and because of the scale you are getting, the profit line is starting to turn in the right direction, driving adjusted operating profits. Is that the new norm for your business moving forward?
So, we're public companies. We want to be really careful about, exactly what we tell people to expect. But I think if you look back over the last several years, we've constantly levered. We've grown GPU by over $400 year over year. We've grown very quickly. Through 2019, we grew at triple-digit rates every year. Slowed down a little bit in 2020 through the pandemic. Last quarter, we're back to 96%. So growing really quickly. If you look at our EBITDA or our earning per share, basically a linear line upward. And so as the business keeps scaling, the economics get continually better. And so, we expect more of the same in the future.
Looking longer term, we really are headed down a direction over the next decade where there's unlikely to be any gasoline-powered cars, or severely less, and replaced by electric autos. How is what you do going to have to evolve because of that?
So I think it's a huge opportunity for us. We sell to a broad swath of American consumers. So across, age or income or, credit or geography, we're selling to all customers. That said, we do kind of shift in the directions that you'd expect as an online retailer. So it is a little bit younger. It is a little bit more affluent. So we're a little bit more likely to sell to customers that are interested today in electric cars. And so I think this transition for us is a big opportunity. Undoubtedly, there are some changes that come along with it, but we're very well positioned to handle that. So when an electric car comes into our system, it just means that the reconditioning process are a little bit different, that you have to have the ability to measure the battery and ensure that it's in good shape, and to be able to charge it up quickly when you deliver to the next customer. There's different mechanical things you have to pay attention to in a car like that. So I think there's some adjustments that get made at our inspection centers, but to the actual business model itself, it's still the business of taking a great car from a consumer who is ready to move on to the next car, buying it from them, preparing it for the next consumer who wants that car, and then giving them a great experience as you sell it. And the underlying propulsion system doesn't really change the core business too much.
Ernie, it's Julie here. Finally, I feel like I would be remiss if we didn't ask you about the report in the Wall Street Journal that talks about the stock sales executed by your father, Ernie Garcia II. And as that story notes, in filings, you guys have said the interests of the Garcia parties may not in all cases be aligned with your interests, meaning the shareholders. Any plans on your part to change any of the governance structures of the company?
Wow. That's a big, complicated question. I could talk for a long time on it. So let me start with this. My parents have been incredibly lucky going through all this. When we tried to raise money 6 or 7 years ago, we went to every venture capital firm out there and couldn't find anyone to fund us. And so, my dad was maybe the only one that was dumb enough to step in and give us money at that time. As a result of the way the business has played out, that's worked out very well for him, and he's been incredibly lucky, and has sold down somewhere between a fifth and a sixth of his position, which I hope people won't begrudge him for too much, but that's the choice he's made, and it's his choice to make. I think as it relates to the interests, for very complicated tax reasons, all of the pre-existing shareholders that existed prior to us going public have a little bit of an interest in us actually becoming more profitable more quickly. And that's really the only place where the interests diverge between the pre-existing shareholders and public shareholders. So we disclose that as is standard in these kinds of setups, but hopefully it's not something that shareholders are too concerned about.
Well, some shareholders are concerned because there's a lawsuit involving some of his sales. Any response you would want to give to that?
So, again, this is it's hard to explain that concisely. What I will say is that there is a lawsuit that we completely expect to kind of be wiped away in hopefully short order here around a sale that we did as the company in 2020. Early in the pandemic, it was important for us to raise additional money, as many companies out there did. And then after that, as the entire stock market did, our stock price rocketed upwards. And with the benefit of hindsight, some have asked whether or not that was beneficial stock sale timing. It was not, is the simple answer there. So that'll all get worked through.
All right, well, we appreciate you coming on here and answering these questions. Good luck this quarter. Carvana CEO Ernie Garcia, good to talk to you again.
Welcome back to Yahoo Finance Live. Taking a look at shares of Pepsi, trading pretty flat in this session, up about 0.1%. Our next guest, though, sees big upside for the stock, raising its price target to $175 a share. Let's bring in Laurent Grandet. He's Guggenheim Managing Director and Equity Analyst. Laurent, it's good to talk to you today. $175, when you look at where it's trading right now, certainly big upside. You've pointed specifically to the North America business that you think could be a big driver. Walk me through your thesis.
Yeah, sure. And actually, it's the beverage in North America. I mean, in my view, is the way, the PepsiCo stock could work. I mean, we know that Frito-Lay North America is doing well. Probably international business is a bit too small to move the needle right now. So really, PepsiCo North America beverage is PBNA. It's really what matter. And really, we went to a low during COVID because of extra costs and the on-premise not being as good as before, but we are recovering. And I think Ramon Laguarta, the CEO of PepsiCo, by rebalancing investment between food or snacks and beverages, reshuffling the portfolio, with the divestment of Tropicana over the summer and acquisition of energy last year, plus, some focus probably more on execution is starting to pay off, and this is what we are seeing in the future. So that's basically the main thing in all of these PBNA, and really, divestiture, reshuffling the portfolio, rebalancing investment, and more focus on execution.
Yeah, let's talk specifically about some of those energy brands that you mentioned. You're talking about Rockstar, Mountain Dew Rise, among them. What do you think is going to elevate to another level here? How is that growth going to be driven?
So what is interesting when PepsiCo bought Rockstar last year is it did allow PepsiCo to invest or to move some of their core brands into energy, but also to make to distribute Bang in the US. So the driver are multiple here. You can have Rockstar that is right now being kind of revamped and relaunched. Velocity is growing. The distribution is yet to come, but with higher velocity, we think that will come up. There is a launch of new innovation behind Mountain Dew as a brand with Mountain Dew Rise, but also something that investors probably need to see is that the addition of Bang in the DSD system, together with the Rockstar volume they didn't have, will drive about 130 basis points of incremental margin just for PBNA, simply because those two products together represent about 12% of the DSD system in the US for PepsiCo, and that is eating a lot of fixed costs. So that's what we see as incremental here.
We're talking $175 a share. What do you think is the biggest risk that could derail this growth story you've laid out?
Yes, right now it's all about commodities inflation and really freight costs, labor costs, labor shortage. So it's kind of all the company we follow in the space. We believe that Pepsi got some pricing power with their brands. They can really ask for more premium price. They can also do what they say. It's a pack price strategy, where they can either reduce the size of the packaging with the same price. So they can play around this. But that's clearly one of the risks. How long will that last, the labor shortage, and therefore drive cost in the system? That's a question mark.
Yeah, it's been a big question mark for so many firms, not just Pepsi, but it's good to talk to you today. Laurent Grandet, Guggenheim Managing Director and Equity Analyst.
Welcome back. Restaurant payments and technology company Toast is one of the latest firms to hit the public markets. It priced its IPO yesterday at $40 a share, coming in above the expected range. Now, shares begin trading publicly on the New York Stock Exchange today. And for more on this offering, we have Toast Chief Financial Officer Elena Gomez with us now. And Elena, congratulations and thank you so much for joining us today. First, I want to kick things off and ask, why was right now the best time to bring Toast to the public markets?
Yeah, no, we're really excited to be here. Thank you for having me. And we believe this is a great opportunity for us to continue to invest in our platform to help restaurants be successful. So this was the perfect time for us to really come out to the markets and really show that we will invest in our platform for restaurants of all sizes.
Elena, you just started at Toast. You took over the CFO role in May of this year. What have been some of your priorities beside leading up to the IPO?
Yeah, we're excited to get back to execution. You know, we've got a long journey ahead of us, and we really view the IPO as a stop on our journey, but we're really focused. If you know anything about Toasters, our focus is restaurant success, and so we're going to get back to business tomorrow and help our customers continue to grow and continue to innovate so that we can see them have success over the next several decades.
Elena, as we think about the restaurant industry throughout the course of the pandemic, of course, challenges with closures early on in 2020, and now reopenings and having to really transition to these different sorts of models with delivery and really accommodating this new flow of customers as we have vaccinations and mobility picking back up. I'm wondering, what are your restaurant customers telling Toast right now about what their main concerns are, and how are you addressing that?
Yeah, no, our customers, you're exactly right that it was a challenging time, but Toast was well positioned with the platform. And really what we've seen is the pandemic was a catalyst. We're seeing restaurants adopt so much technology now and really viewing it as a key differentiator in their business success. And so we're excited about them adopting our guest products, which are all the online delivery and takeout that all of us are probably using in our homes today. And we believe some of those trends are really durable over time.
Elena, Toast had to lay off about half of its workforce at the height of the pandemic. Have you been able to get those workers back?
Sorry, say that one more time.
Toast had to lay off, I believe, close to half its workers, really at the height of the pandemic last year. Yeah, have you been able to get those workers back?
Yeah, no, we're, what's really great is we've been able to continue to grow, and our restaurants have needed us. And so we've been leaning into investing because we believe that restaurants really need a platform to be successful. And so that was a really important time for us to get back to business. We're battlefield tested during the pandemic, and we're ready to continue to help our restaurants over time continue to grow. And in order for them to grow, we need to continue to invest in our platform.
When you think about competitors in this space, who would you consider the biggest competition here? Because, of course, we have Square really working with small businesses, restaurants with point of sale systems. We have, of course, delivery companies that have direct relationships with these restaurants. So how do you think about that ecosystem around the restaurant industry right now and where Toast fits into that?
Yeah, no, I'm excited to share that, when we are in a deal with restaurants, we win the majority of the time. So it speaks to what differentiates Toast. And when you think about what differentiates Toast, we're purpose-built for restaurants. We're very focused on being deep in the communities where we all go to restaurants, and we're going to continue to out-innovate. That is our goal. We want to continue to make our platform better, and we're really pleased that more than 50% of our customers use more than 4 products on Toast already. So, and that's what the products we have today, and we're going to continue to innovate and hope to continue to grow our customers. We're serving close to 50,000 customers today.
Yeah, the S1, Elena, talks a lot about other initiatives beyond what you're doing now. Where else do you think Toast can play in the restaurant space?
We continue to believe that we're going to focus on all the stakeholders in and around the restaurant, whether that's the restaurant owner, the employee, the guest, and so you'll continue to see innovation around those key stakeholders. We believe all of them could benefit from better technology solutions, and now restaurants are really well positioned to understand the value of technology, and Toast as a platform is well positioned to support restaurants of all sizes and all verticals.
All right, thank you so much, Elena Gomez, Toast Chief Financial Officer. Welcome back. Time now for our call of the day. And today we're looking at shares of Vimeo. Now, those are trading higher by just over 3.5% this morning. And that's after Wells Fargo initiated coverage of Vimeo with a bullish overweight rating. We have Wells Fargo Senior Equity Analyst Brian Fitzgerald with us now. Brian, thank you so much for joining us. You wrote that you believe Vimeo's latest pullback since its second quarter results have been overdone and that the valuation from here is an attractive entry point. What's the case for the stock to go higher from here?
Yeah, thanks, Emily, for having us. Look, we think Vimeo has a large and attractive addressable market for SMBs and enterprise video software tools. It's a $70 billion market by 2024. The upward inflection during COVID only pulled forward secular growth, and enterprises and small, medium business adoption of video still remains early. So we think there's robust multi-year top line trajectory. We have a 30% 5-year CAGR. And that's going to be driven by ramping consumer digital video consumption, particularly across mobile, connected TV, and over the top. It's the proliferation of social media and marketplaces for video distribution. And then it's the short lifespan of video content assets. The average Twitter tweet has a lifespan of about 18 minutes.
Brian, how large a threat is YouTube?
It's a great question, Brian. So when we think about Vimeo, we call it the largest paid tool set. When you think about YouTube, YouTube probably has about 85% of the share in terms of domains and organizations. But among paid video software tool providers, Vimeo is the market leader in terms of brand, superior control, end-to-end functionality, and ease of use. It's a really easy lift. And time to value advantages make it work versus competitors there. So innovation, R&D investment, and partnerships and distribution breadth are what resonates with Vimeo.
Speaking of partnerships, we recently had Vimeo announcing a partnership with Asana. I'm wondering, are there any other software or SaaS players that you think could make for a good tie-up here for this company?
Well, absolutely. It's any software companies that need to use video in terms of work share flow or collaboration. It's also the social touch points. And so they also recently announced partnerships with TikTok, Pinterest. So anywhere you want to reach out and touch customers with video from an e-commerce standpoint, or anywhere where you need to use video to amplify collaboration. So I think there's a lot of runway in terms of how they can grow the market.
Brian, you mentioned in the note that Vimeo is still reporting monthly statistics. How do you expect, first of all, what are they reporting each month? And what are you looking for over the next few months?
Yeah, so this comes out of their heritage from being with IAC, which moved last year to reporting monthly stats. Match does it as well. Angie does it as well. And so they're going to continue to give us monthly updates of how the business is trending. I think part of the pullback of the stock was on a light print in Q2. They did say there was some headwinds from COVID, crosswinds from COVID. They're lengthening the enterprise sales cycle a little bit. We think the pullback is overdone, and we think the stock looks attractive here with great upside. In terms of the monthly points, some investors are trying to take that 2Q print and then the quarterly updates and string out, what does the Q4 print look like? And we think that's too early to do in terms of a company that's growing really fastly, that's expanding their sales force, that's growing internationally, and that's also got a great product roadmap.
And Brian, you spotlight also in your note that Vimeo has a history of making acquisitions, three major ones since May 2016, VHX, Livestream, and Majesto. Do you see them making other acquisitions, and what would you like to see them make to help bolster their top and bottom lines?
Well, I would like to see them expand internationally. So any international acquisition would make sense for us. Any tool sets that would help you create and speed up the ability to deploy to social networks as well. If you look at what's happening with that shortened lifespan of video content assets, particularly around social, it's necessitating more efficient automated creation tools. So any acquisition around that front would be great.
And Brian, I know you cover a number of other social media stocks and technology stocks in this sector. And I want to ask just a little bit broadly, as we think about advertising revenue trends, user growth trends, it's been a little bit of a choppy quarter on the COVID front with users starting to go back out, this reopening taking place, and then kind of shutting down, at least in the US in late summer, mid to late summer. So what are your expectations here when we think about a Facebook, a Twitter, or a Snap, thinking of some of those trends?
Look, I think what we're seeing across the online advertising front is ad rates, CPMs that are at pre-pandemic levels, higher than pre-pandemic levels. Engagement continues to hold in there. And this is because we're continuing to see a shift towards social shopping, or what we're calling the democratization of e-commerce and shoppable ad formats inside of Pinterest, Snap, Facebook, Instagram. So if you want to find your target audience and communicate with them, market to them, communicate with them, and then transact with them, and you can do all that within these social spheres, that's a very compelling advertising use case. So you continue to see all those social spheres I just mentioned continue to grow that e-commerce piece of their business very well. And with that comes the great ad rates because of the great ROI you see from these shoppable ad formats.
Let's lock in on Facebook briefly here, Brian. This has been a Teflon stock. Despite all of their troubles, most recently now you have the Wall Street Journal with their Facebook files, iOS concerns. This stock has continued to do well. Can you explain to the average investor, why does this continue to happen? Why is Facebook so Teflon in the markets? And do you think it could continue? Because realistically, the headline risk seems to only be going up from here.
Well, it's their breadth. I mean, they literally touch everyone on the planet, and the majority of small, medium businesses are on their platform as well, who aren't even using the ad products. So if you think about that ability as we open up locally to reach out and touch on a one-to-one basis your local consumer with a compelling shoppable ad format, that's great ROI. That's great ad spend. And so we think as we do continue to open up locally, that's one of the reasons why Facebook is so resilient.
All right, Wells Fargo Senior Equity Analyst Brian Fitzgerald, thank you so much.
Right now, you can't be chatting about cryptocurrencies and in the same breath not discussing potential regulation of the space. How governments globally deal with the rise of crypto will be key to how investors put money to work in the space moving forward. Mark Palmer is BTIG's Managing Director of Digital Asset Research and joins us now. Mark, good to see you here. So you're coming hot off your inaugural BTIG Future of Digital Assets Conference. Big turnout for you. 84 blockchain and crypto companies appeared, really, I think, highlighting the enthusiasm in the crypto space. What was the mood in the conference amongst those that attended about regulation? What were they telling you?
What was really interesting was that as much as the companies that were presenting were very much focused on what was going on from a regulatory perspective, they weren't running away from the concept of being regulated or viewing that as being negative per se. In fact, it was quite the opposite. What many crypto companies are looking for more than anything else is a removal of the uncertainty that has been shrouding the space up to this point. In the absence of regulatory clarity, there is going to be a suppressive effect on valuations across the board. There are questions that are causing companies to pause to a certain extent with regard to executing on their strategies because they don't know what the regulatory landscape is going to look like. And so interestingly enough, we heard companies saying, with regard to regulation, we'd like to see it occur. Obviously, they'd like to see that occur in a measured manner where there are reasonable guardrails put around the space, but they're not shying away from it.
Hey, Mark, it's Julie here. I mean, is this a situation of be careful what you wish for, right? Because what guidance it seems that the industry has gotten has not been terribly positive. I mean, when you see some of these companies pull back on their lending products, for example, because of the guidance that they have gotten from the SEC, opaque though it may be, according to them, I mean, when we get regulation, couldn't it actually crimp the industry?
I think there's a concern that in the near term, we could see that sort of an impact. And quite frankly, I am of the view that a lot of these issues are ultimately going to be decided in the courts. So I think when you hear industry executives talk about how regulation could be a positive, what they're not talking about is extremely heavy-handed regulation. But for example, Mike Novogratz from Galaxy Digital was at our conference, and he said, what you are seeing in DC is not an existential threat. There's no one in DC who's looking to kill the crypto industry. But in the near term, you could see a bumpy road. At the end of that road, if there's clarity, then it will be well worth it. Going into 2021, we have said we believe that this was going to be a really critical year, that there could be a lot of blood spilled along the way as that regulatory clarity comes to the fore. We believe that a lot of that, again, is going to come down to the courts. Front and center is, of course, the case SEC v. Ripple, which is working its way through the courts right now. That may provide at least an indication of where things go from here with regard to the decision. If Ripple prevails in that case, then I think the SEC is going to have a more limited path forward with regard to regulation. If the SEC wins, then they're going to have more of an upper hand.
And Mark, just a quick follow-up on this. Bloomberg News has reported that the pick to head the Office of the Comptroller of the Currency, the Biden pick, is Saleh Omarova, who's a law professor who's been critical of the cryptocurrency industry. How significant would that be?
Well, I think if you look at where the OCC has been in the past year, you had Brian Brooks as the interim head of the OCC last year. He was extremely supportive of the crypto industry, and we saw companies like Paxos able to get national trust bank charters as a consequence. The likelihood of any crypto company getting a national trust bank charter at this point, I think, is essentially nil. Which makes those that do have these, Paxos being one company, Anchorage being another, in a really favored position because they were already able to get that distinction. Now, we do believe that the likelihood that the federal government is going to be supportive in this regard, again, is almost non-existent. What does that mean? It means that we now revert back to the states. And if you look across the country, there are states such as Wyoming, South Dakota, Nebraska, Texas, that have been very supportive of the blockchain and crypto space. They will provide what are effectively state licenses so that these companies can operate. And it just makes it that much more challenging for a company that's looking to grow in a big way, given the fact that they are somewhat confined.
Mark, this is Emily. I'm wondering, based on where things stand now, do you think there's enough of an understanding about crypto in DC based on the people in place at present, enough interfacing between crypto leaders and politicians? Because to Julie's earlier point, there have been instances of outcry against proposed legislation coming out of DC. I mean, just thinking back over the summer with the infrastructure bill, those proposals and the amendments around who should be taxed and who should be required to comply with some of these crypto tax reporting standards had generated so much debate within the crypto industry itself.
Yeah, that's another thing that came out of our conference yesterday. Mike Novogratz, who I mentioned earlier from Galaxy Digital, said that the crypto industry has really been late to the game in terms of communicating effectively with Capitol Hill. as well as with regulators. They just were not focused on that over the last number of years. Frankly, a lot of these companies were simply focused on building their own businesses. But they need to catch up as a consequence of that, because what was said again and again yesterday is that there is an education gap. You have regulators and lawmakers who are being tasked with regulating or providing legislation around the crypto space who frankly don't have sufficient understanding of it to be able to make those kinds of decisions in a really informed way. So there is definitely going to be a ramp up of that effort by the crypto industry in general to get lawmakers to the point that they better understand the benefits of cryptocurrency, the benefits of blockchain technology, so that when they do get to the point that they're voting on this, they'll be able to do so in an informed manner.
Mark Palmer, BTIG Managing Director of Digital Asset Research. Always good to see you. Congrats on the conference debut. Restaurant stocks have treaded water in recent months as investors voice concerns over the Delta variant's impact to consumer mobility. But our next guest says he is pushing all his chips onto the board with restaurant stocks. Coming out with a host of upgrades this morning, Jefferies restaurant analyst Andy Barish joins us now for our call of the day. Andy, really good piece of research here. This line, among many, caught my attention. You say it's the best environment for casual dining since the exit of the Great Recession. Make your case.
Yeah, thanks for having me on, first of all, guys. Nice to see you. Yeah, it's really the damage done, unfortunately, to a lot of independents in the sector during the past 18 months of the pandemic. It's caused a huge amount of capacity reset. So coming out of it, the large chain restaurants, which, as you mentioned, we upgraded many of this morning, are very well positioned to take incremental market share in the form of better same-store sales growth, including traffic growth, as well as potentially accelerating their unit growth as well, which, both of which we think will be rewarded with higher valuations and higher stock prices.
One of the names I believe you upgraded, Andy, was Cheesecake Factory. And if I read your report right, you recently had a non-deal roadshow with that executive team. What did they tell you? And will they be bringing back a dividend anytime soon?
Yeah, good question. Yes, we did have a chance to speak with them and investors. And really the big concerns in the industry of late, beyond Delta, obviously, have been the inflation concerns that we're all talking about and seeing in the headlines around commodities and labor. And really what Cheesecake management re-emphasized was that they have the pricing power and the use of some other technology and efficiencies to offset some of the near-term inflation and continue to return profitability back to pre-COVID levels. And I think that's really the theme we're going to continue to see for a lot of the casual diners. In terms of returning cash to shareholders, I didn't talk a ton about it in the upgrade report this morning, but I think that will be another layer of positivity for these stocks in that they will generate free cash flow again in a fairly significant way, like Cheesecake Factory. And I think as they get into 2022 and put some of the bank credit amendments behind them, they will be returning cash to shareholders in the form of dividend and probably stock repurchase in a lot of cases as well.
Hey, Andy, it's Julie here. Well, Soz kind of zoomed in. I'm going to zoom back out for a second and ask more about Delta and how you're thinking about Delta and its effect on the restaurant industry here, and whether you think it's just a matter of sort of a little bit of a delay in a recovery for some of these names.
Yeah, hi, Julie. To be honest with you, I think the market and many thought it was going to be worse than what we're seeing in our data. We have some proprietary foot traffic data. We also get weekly same-store sales data on the industry, and it's been surprisingly quite resilient. There's been some ups and downs, but generally the trend is bottoming out to picking up. I think in some of the hot spots as Delta moves around. Unfortunately, you do get issues with team members in restaurants, which, maybe impact sales because obviously then you have to contact trace and, lose a bunch of people for a week or two. And that's not easy in a tough labor environment. But generally, the consumer demand has been quite good. The comparisons get easier as we move into the holidays because of last year. Unfortunately, there was the wave of COVID that definitely impacted the holiday season. And we're projecting a very strong holiday season for the restaurant industry this year.
Andy, you mentioned the tough labor market, which we have talked about an awful lot. Is that a problem for this industry, or is it actually sort of a hidden benefit in some ways because their costs are lower? But on the other hand, do you have a lot of angry customers if there's not enough people working?
Yeah, I'm glad you asked that question. And yeah, I really don't understand the angry customer, thing. People are working hard and, in a tough environment, but unfortunately it does happen in restaurants as well as airplanes and other crazy stuff, as we all know, unfortunately. But what I think's going on in the labor environment, yes, it's tight, it's really tough. But what the large chain restaurants tend to have is a really good culture that provides excellent training and a pathway for growth. So I think the larger restaurants are really in an advantageous position to use those special factors in their human capital proposition, if you will, to continue to attract talent and provide a runway for growth for that talent, so someone can theoretically have a career in the restaurant industry. So I do think the bigger companies, with great culture, the ability to pay better, the ability to have better benefits, are in an advantageous position. No, not everybody is as staffed up as they like, but at this point, it's really, not causing any major issues. And the industry, just so people know, the industry's been seeing mid-single-digit wage inflation for 5+ years now. So this is nothing new for restaurants.
Andy, back to some of your picks. Red Robin. Now, we talked to CEO Paul Murphy recently. He told us they are rolling out Donato's Pizza inside their restaurants. How big of an initiative is that for the company? Is it going to move their sales and profits?
Yeah, it sounds like the early test results have been very good and very incremental. Obviously, it meets the need of the off-premise consumer as well as an addition to the menu. It doesn't sound like that big a capital cost, and I don't have the rollout numbers off the top of my head, but I've known Paul Murphy for a long time, and I think they're going to execute against the plan. And Donato's is just one of several areas that they're really focusing on to improve the Red Robin experience and broaden the customer base and frequency. And he is a very, very good turnaround CEO, and I think we'll see the successes over the coming quarters and years.
And lastly, Dave & Buster's, the CEO abruptly retiring this week. Now you have Kevin Sheehan in there. I remember him when he used to run Norwegian Cruise Line, so an interesting choice to take over there. How will his leadership impact the stock?
Yeah, well, first of all, I've got to give Brian Jenkins, the CEO and former CFO, a lot of credit for the incredible heavy lifting that had to go on through the pandemic. As you can imagine, the Dave & Buster's business model with, the high touch games and bars is, probably one of the most impacted businesses, but their recovery has been remarkably strong on the sales line, just showing that the consumer wants to go out and have fun experiences. Their margin performance has been nothing but breathtaking. And I think Brian's, really put the initiatives in place that can continue to drive the business going forward. Kevin is the chair of the board. This will be a temporary position as the interim CEO. as they've already begun the search, for a permanent CEO, which, hopefully will be in place over the coming months to continue to re-energize the brand, which I think is heading back in a really positive direction right now.
All right, we'll leave it there. Jefferies restaurant analyst Andy Barrett joining us for our call of the day. Really good research here. Have a great weekend.